An economic tsunami like we've never seen before is heading our way, and it's ready to crash over our heads. 7 warning signals are flashing red right now, signals that preceded every major financial crisis in history. And there are legendary investors who are declaring we're heading into garbage lending territory worse than 2008. Stay with me to the end of this video. We're going to cover exactly what's happening to your money and what you need to do about it. Welcome back to StockScope Live. I'm your host, Ali, and today we're diving deep into these economic crisis signals that are keeping Wall Street executives up at night. This isn't fear-mongering as usual. These are facts pulled directly from the Federal Reserve data, major financial institutions, and the world's top investors. If you care about protecting your wealth in 2025, you should watch this entire video. 20 minutes could save you a lot of money. Before we dive in, hit the subscribe button and ring the notification bell. We're talking about critical economics updates, and you don't want to miss what's coming next. All right, let's get into it. Signal number 1, the private credit time bomb. Let's start with what legendary bond investor Jeffrey Gundlach, often called the Bond King, just warned about. On November 17th, Gundlach went on record saying that the private credit is engaging in garbage lending, and it will be the flashpoint of the next financial crisis.
The most ridiculous argument of all for private credit has been private credit belongs in every portfolio because it lets you sleep at night, because it helps you ride out the volatility of your public credit. Again, that's just a repackaging of the volatility. If you don't market to market, there's no volatility. But if the price goes from 100 to 0 in a matter of a few weeks, there's something untoward is going on. And so I'm very, very negative on those types of non-transparent markets. It reminds me, I've been saying this for probably 2 years now, that the next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even, but I'm very negative on that.
Now, why should you care about private credit? Because this market has exploded from $1 trillion in 2020 to $1.5 trillion today, and it's projected to hit $2.6 trillion by 2029. And here's the problem. Private credit operates in the shadows, often called shadow banking. Unlike traditional bank loans or corporate bonds that are regulated and transparent, private credit deals happen behind closed doors. Hedge funds and private equity firms are lending money to companies that can't get traditional financing, often for good reason. Okay, Gundlach specifically called out PIK loans, the payment in kind loans, where borrowers don't actually pay cash interest. Instead, the interest just gets added to the loan balance. It's like paying your credit card with another credit card. And when one of these loans go bad, Gundlach warns, there's never just one cockroach, just like Jamie Dimon said. According to Bloomberg, reporting just 15 hours ago, several private credit hedge funds are already closing down. UBS O'Connor just lost its private credit chief right before a major deal with Cantor Fitzgerald. That's not a coincidence, folks. That's insiders getting out before the music stops. The Fed's own stress test shows that private credit is not a systemic risk. But remember, they said the same thing about subprime mortgages in 2007. This is your early warning. Next, commercial real estate, and this one's a monster. Here are the numbers you need to know. $957 billion in commercial real estate loans are maturing by the end of this year. That's in the next month and a half. That's nearly triple the 20-year average. And here's the kicker. Approximately 1/5 of those maturing loans are office loans. Now, why does that matter? Because office vacancy rates are sitting at 20% nationally. Think about that. 1 in 5 office buildings is sitting empty because the work from home revolution. Companies aren't renewing leases. They're not coming back. So you've got building owners who took out loans at 3% interest rates back in 2020, and now they need to refinance at 7 to 8% interest rates for buildings that are nearly empty, that are worth 30 to 40% less than they were 3 years ago when they were purchased. The FDIC's 2025 risk review, and I'll link this document below, specifically flags commercial real estate as a major source of stress for regional banks. We're talking about $1.5 trillion in CRE debt coming due by the end of 2025. And who holds most of these loans? Small and regional banks. The same banks that failed in 2023 with Silicon Valley Bank and First Republic. Commercial real estate delinquencies have now surpassed the 2008 financial crisis peak. ITM Trading just published a report warning that we're facing a massive banking crisis from this debt bomb. One expert at Jemerson Bird Law firm titled their analysis, "The Approaching Commercial Real Estate Financial Crisis, a Looming Threat." This isn't speculation. This is simple math. When you can't refinance and you can't sell, you default. And when you default, the banks holding those loans take losses. And when enough banks take losses, you get 2008 all over again. Signal number 3 is the liquidity crisis. Let's talk about something most people don't understand, but affects everything. Liquidity is basically the oil in the engine of the financial system. When there's plenty of it, markets run smoothly. But when it dries up, everything seizes. Here's what's happening in a nutshell. According to Forbes, reporting just earlier today, the Fed is having to actively intervene to keep markets afloat. And we can see this in the charts of the Fed repo facility. We can see major spikes that we haven't seen in the last 4 years, not even in 2023. In October 2025, just last month, the U.S. banks borrowed over $15 billion from the Fed's standing repo facility in just 2 days. And that's up to $150 billion over several weeks. The key repo rate spiked. That's a stress signal. The New York Fed released a report 6 days ago showing that the Treasury market liquidity hit some of its worst levels since March 2023. You know, when Silicon Bank collapsed. The report specifically says, and I quote, "Available depth declined to the lowest levels since March 2023. And get this, Seeking Alpha published an analysis 3 days ago titled, "A liquidity crisis is already here, and the Fed's next move could change everything." Their conclusion was, we're not heading towards a liquidity crisis, we're in one. The Fed is just bumping in enough emergency liquidity to hide it. Now, why does this matter? Because when liquidity dries up, asset prices crash because people need liquid cash. So they will sell their assets at a fire sale to get that cash to cover whatever they need to cover. Stocks, bonds, crypto, everything that relies on easy money to maintain its value gets hammered. And things that are most speculative often go down first, and this is what we're seeing today. Bitcoin dipped under 91K. Why? Because most people who are fearing risk and they're on margin calls or on their whatever they're doing, taking out loans, they're dumping, and they're dumping fast, and that's crashing crypto right now. And they're moving their money, either they're paying back their loans or covering their margin, or they're moving it into more safer assets. The Atlantic Council warned 5 days ago that the real danger isn't even tech stocks. It's the tightening US dollar funding globally. And this is sending the dollar value in the DXY up because there's less dollars in the system This is the plumbing problem. Nobody is talking about on mainstream media, but it's one that breaks everything. Signal number 4. Let's move to the Federal Reserve and interest rates. Just 2 weeks ago, markets were pricing in a 70% probability that the Fed would cut rates in December. Fast forward to today, that probability just dropped to 50%. According to the CME FedWatch tool and the Wall Street Journal reporting just 4 days ago. Now, why does this matter? Because markets have been rallying on the assumption that the Fed would come to the rescue with rate cuts. Lower rates means cheaper borrowing, higher stock valuations, and a softer landing for the economy. But what people don't realize is the Fed cuts can't solve a liquidity crisis. And it can't solve these other issues like real estate loans and property tax and everything else we're talking about. But the Fed isn't cutting as aggressively as expected because inflation isn't cooperating. The core PCE forecast for 2025 just got revised up from 2.2 to 2.5%. That's moving in the wrong direction. Goldman Sachs still expects a cut in December, but JP Morgan just revised its recession probability to 40%, down from 60%. But it's still uncomfortably high because the Fed isn't going to cut rates for the sake of hoping something will get fixed. They've cut rates, they've not seen the results come through on inflation, and now they know that the problem isn't there, and it's likely they won't cut again. Here's the trap. If the Fed cuts rates, inflation could spike again. If they don't cut rates, the economy could tip into recession as high borrowing costs crush businesses and consumer. The consensus is the Fed is fracturing. There's a lot of Fed chairs saying we're not going to cut, and a bunch of them saying we have to cut. CNBC reported 4 days ago that the Fed officials are casting doubt about the December cut. When the Fed loses its consensus, markets get nervous. And nervous markets, they sell first and ask questions later. Signal 5. Let's talk about Main Street, regular people, not Wall Street. According to the Joint Center for Housing Studies at Harvard, a record high 22.6 million renter households are cost burdened as of 2023. Now you might ask yourself, Ali, what does cost burden mean? That means that they're spending more than 30% of their income on rent. Nearly half of all U.S. renter households are struggling to afford housing. The National Low Income Housing Coalition released their Out to Reach 2025 report in July, showing that minimum wage simply cannot cover rent in any state in America. Eviction rates have leveled off in some areas, but California's Public Policy Institute reports that rental relief has had to distribute over $4.7 billion to some 370,000 households just to prevent mass evictions. And as I stated in my other video talking about mortgage rates, even after the Fed cut, mortgage rates are now at 6.38 for a 30-year loan. And people think that rate cuts means cheaper mortgages. It does not. Watch that video to know what we're talking about. Now let's talk about the domino effect here. When people can't afford rent, they cut back on spending. When they cut back on spending, businesses suffer. When businesses suffer, they lay off those people. And when people get laid off, they can't pay rent. And the cycle feeds itself. Yale's eviction lab reported that between 2020 and June 2025, over 12,000 landlord-tenant pairs avoided eviction thanks to financial assistance. But the assistance is running out. And mortgages? You ask? MSNBC reported just 5 hours ago on Trump's proposed 50-year mortgage plan, calling it a Band-Aid on a bullet wound. The housing affordability crisis isn't an accident. It's by design, created by decades of restrictive zoning, insufficient supply, and financialization of housing. Mayors across the country are saying housing affordability will decline over the next year. Stateline reported just 3 weeks ago that more than half of mayors expect things to get worse. When housing, the single biggest expense for most Americans, becomes unaffordable, the entire consumer economy is at risk. And that is a warning sign to you. Signal number 6. Here's a signal most people aren't watching, but they should be. The Port of Los Angeles. The Port of LA is America's busiest seaport. It's literally the gateway for goods coming from Asia. Everything from electronics to clothing to machinery. You name it, it comes through there. So when the volume drops there, it's a leading indicator of consumer demand. So in September 2025, imports at the Port of LA dropped for the second consecutive month. They fell about 7.5% compared to September last year. Despite handling a record volume in Q3 overall, the trend is turning negative. So you might ask yourself why. There's 2 reasons that I can think of: tariff uncertainty and weakening consumer demand. The port actually broke a century-old record back in July when importers rushed to beat the threats on China tariffs. They front-loaded shipments, essentially borrowing demand from the future. And that surge is now over, and the volume is normalizing. But at worst, it's declining. The port's executive director warned in September that, I quote, "I expect container volumes to ease through the rest of 2025, especially against last year's unusual high number," end quote. This isn't just about shipping. This is about the real economy. When imports decline, it means that businesses aren't ordering more inventory. And they don't order inventory unless they expect sales to drop. Now, lower port volume preceded both the 2008 financial crisis and the 2020 recession. It's one of those quiet indicators that screams trouble ahead if you know where to look. And right now, it's flashing yellow, heading towards red. Signal number 7, finally, we can talk about corporate debt defaults. S&P Global just released their October 2025 report, literally 9 hours ago as of this recording, showing that 10 corporate defaults occurred in October alone. That might not sound like a lot, but we are on track for default rates of 5.5 to 6% for leveraged loans and 4 to 4.5% for high-yield bonds. Here's the scary part. That might not mean anything to you if you're not financially savvy. This will make sense. $42 billion in corporate bonds have been downgraded to junk status in 2025. That's up from $6 billion in 2024. That's a difference of $36 billion or 7 folds in 12 months. This is the biggest wave of downgrades in more than a decade. Moody's is tracking 241 companies at high risk of default, the highest number in nearly a year. Fitch maintains that default landscape is being reshaped by surprise bankruptcies and private debt. Remember First Brands? Everybody's been talking about for the last 2 months? Their bankruptcy in October surprised the entire market because of hidden off-balance sheet financial issues. Sound familiar? That's exactly what happened with Enron, for those who know what Enron is. Chapter 11 bankruptcy filings increased by 22% in Q1 of 2025 compared to 2024. Chapter 11 bankruptcy filings increased by a whopping 22% in Q1 2025 compared to Q1 2024. Corporate Services Corporation calls this the 2024-2025 wave of bankruptcies, and it's not stopping. Here's why this matters. Corporate debt defaults don't happen in isolation. When companies default, their suppliers get hurt. Their employees get laid off. The banks that lent to them take losses. The pension funds, the 401ks that own their bonds lose value. Everything is connected. When one domino falls, the others follow. The leveraged loan default rate hit 5.9% in September, according to Moody's. That's approaching the danger territory. Anything above 6% historically has coincided with recessions. In my opinion, we are in a recession. We're not heading into one. So there you have it, folks. 7 crisis signals that are flashing red at the same time. And trust me, there's many, many more. We simply don't have the time to cover it all in one video. The 7 are private credit garbage lending, $1 trillion in CRE loans maturing with nowhere to finance, the liquidity crisis that already is underway, the Fed rate cut probabilities collapsing, the housing affordability and eviction crisis, the Port of LA volume declines, which signals demand weakness, corporate debt defaults hitting decade highs. But here's the really important question. What do you do about it? Well, first thing is don't panic. Panic selling is how you lock in losses. But being informed and prepared, that's how you protect yourself, or maybe even profit. Here's my recommendations. Number 1, build cash reserves. A lot of large investors, Berkshire Hathaway, Jeffrey Gundlach, they all are hoarding cash. We know that Warren Buffett is now holding a staggering $380 billion. Because that's not being bearish, that's being smart. Cash gives you options when assets go on fire sale. Number 2, diversify away from overvalued sectors. Gundlach calls this one of the least healthy stock markets of his career, and he's been in this for 40 plus years. If you're overweight in tech and speculative growth, consider rebalancing. Number 3, avoid illiquid assets, private credit, venture capital, private equity. These are the areas at most risk. If you can't sell it quickly, you don't want to own it going into a crisis. Number 4, focus on quality. Blue chip dividend stocks, treasury bonds, gold. Boring is beautiful when everything else is falling apart. Number 5, make sure you stay informed. Subscribe to this channel because I'm tracking these signals and will alert you to any major developments. We're not putting out a lot of videos on what stocks to buy because there aren't any. We're talking about blue chip dividend stocks only. That's where you should invest your money. And I don't need to cover that in a video for you to know which stocks those are. If you found this video valuable, make sure you smash the like button. Leave a comment with your biggest concerns about the economy and share this with people you love or people who need to see it. Remember, the best time to prepare for a crisis is before it happens. Don't wait for the headlines to catch up. The signals are here. The question is, will you act on them? Until next time, stay informed, stay prepared, stay safe, and I'll catch you in the next video.